Accounts Teachings Problems and Solution of Retirement of a Partner by Ramesh Kumar. Now the problem is X by Z were sharing profit and losses in the ratio of 5:3:2. As on 31st December 2020, Y retired on that date and their balance sheet was as under. Liabilities amount, assets amount. Under liabilities, capital X 2 lakh, Y 4 lakh, Z 3 lakh. General reserve 10,000, bills payable 20,000. Total of balance sheet is 9 lakh 30,000. On asset side, fixed assets 4 lakh, debtors 60,000, bill receivable 40,000, bank 2 lakh 50,000, stock 1 lakh 80,000. Total of balance sheet is 9 lakh 30,000. Now adjustments. Number 1. Fixed assets were valued at 3 lakh 60,000. It means fixed assets have decreased with 40,000. Number 2. A debtor became insolvent and rupees 4,000 were due from him. Have been bad debts. That is, a person owed us 4,000 but he became insolvent and therefore that amount has been treated as bad debts. Number 3. X and Y agreed to bring as much bank that Y is paid off and their capitals are in their new profit sharing ratio. What would be the new profit sharing ratio? That after retirement of Y, 5:2 will be the remaining ratio, will serve as new profit sharing ratio and gaining ratio. Y. Goodwill is to be paid to Y 70,000. To be charged to X and Z without raising goodwill account. That retiring partner will get goodwill 70,000 but it will be charged from remaining partners. But goodwill is not, the word goodwill is not to be used. Give journal entries, show revaluation account, capital accounts and new balance sheet. Now first we are starting with journal entries. First is revaluation account debit 44,000 to fixed assets, 40,000 to debtors 4,000. Narration being decrease in the value of assets 44,000. Now there is no other item for revaluation. So this would be the total loss will be charged from all the partners in their profit sharing ratio. X capital account debit 22,000, Y capital account debit 13,200, Z capital account debit 8,800 to revaluation 44,000. Being loss on revaluation transferred to partner's capital account. Now for goodwill. It is in gaining ratio. When is silent, the remaining serve as a new ratio as well as gaining ratio. Y is retiring. Therefore, the remaining would be 5:2 will serve as a new ratio as well as gaining ratio. The X capital account debit 50,000, Z's capital account debit 20,000 to Y's 70,000. Being goodwill transferred to Y without raising goodwill account. Then on liability side we find general reserve 10,000. General reserve is a previous profit which the partners have not distributed but have kept for future contingencies. Now when the partner is retiring, this will be transferred to all the partners in their profit sharing ratio. So general reserve account debit 10,000, to X capital 5,000, to Y capital 3,000, to Z capital 2,000. Then if we prepare the total, we find out the total capital, we will give in through working note. We find there that X has a shortage of capital, so he will have to pay the capital bank account debit to X capital 3,49,857. Being shortage of capital brought by X in new ratio. And Z has a surplus of capital which we will pay back to him. Z capital account debit 80,057 to bank 80,057. Total amount payable to Y comes to 4,59,200. So Y's capital account debit to bank 4,59,200. Now we are having partners capital account, particulars XYZ, particulars XYZ. Buy balance BD, under X 2 lakh, under Y 4 lakh, under Z 3 lakh. Buy X capital, under Y 50,000. Buy Z capital, under Y 20,000. Buy reserve, under X 5,000, under Y 3,000, under Z 2,000. Buy bank, Y has shortage of capital 3,49,857. On the debit side, to revaluation, under X 22,000, under Z 13,200. To Y capital, under X 50,000, under Z 20,000. To balance CD, this is the new capital which is in their profit sharing ratio, under X 4,82,857 and under Z 1,93,143. The total of capital accounts is coming 5,54,857 X. For Y 4,73,000 and for Z 3,02,000. Same thing is on credit side. X 5,54,857, Y 4,73,000 and Z 3,02,000.